Hey everyone, Pavan Kumar, more here. Let's be real. Most people find analyzing stocks about as appealing as a root canal. But just like taking care of your teeth, understanding the fundamentals of stock analysis is crucial for your financial health. We're not talking about chasing the next hot stock tip here. This is about empowering you to make informed investment decisions based on real data. Because let's face it, throwing darts at a stock board might be as effective as blindly following the hype. In this video, we're diving deep into the essential parameters used in stock analysis. We'll break down complex concepts into bite-sized pieces that anyone can understand. Whether you're a complete beginner or have some experience, this video will equip you with the tools to analyze stocks like a pro. So buckle up and get ready to master the fascinating world of stock analysis. Think of a company's financial statements as its report card. The income statement tells us how much money the company made, revenue, and how much it spent expenses over a period of time. It's like tracking your income and expenses each month, but on a much larger scale. Next up, the balance sheet, a snapshot of the company's assets, what it owns, liabilities, what it owes, and equity, the difference between the two, at a specific point in time. Finally, the cash flow statement tracks the movement of cash both in and out of the company. It's like following the money trail to see where it's coming from and where it's going. Imagine you're buying a house. You wouldn't just pay the asking price without comparing it to similar houses in the area, right? The same goes for stocks. Valuation metrics help us determine if a stock is overpriced, undervalued, or just right. Metrics like the price-to-earnings, PE ratio, price-to-book PB ratio, and price-to-sales PS ratio provide insights into how much we're paying for each dollar of earnings, assets, or sales, respectively. By comparing these ratios to industry averages and historical trends, we can get a better sense of whether a stock is a good deal or not. Remember, just like buying a house, we want to make sure we're getting the best value for our money. Investing in a company that's not growing is like buying a car that only goes downhill. Growth metrics help us identify companies that have the potential to increase their earnings and revenue over time. Metrics like revenue growth rate, earnings per share, EPS growth rate, and dividend growth rate can tell us a lot about a company's trajectory. A consistent track record of growth suggests that the company is effectively adapting to market dynamics and capitalizing on opportunities. Remember, past performance is not indicative of future results, but strong growth metrics can be a good indicator of a company's future potential. Return metrics are the name of the game in investing. After all, we want to see our money grow. Metrics like return on equity, return on assets, and return on invested capital measure how efficiently a company is using its resources to generate profits. Think of it like this. ROE shows how much profit a company generates for every dollar of shareholder equity. ROA, on the other hand, measures profit per dollar of assets. And ROIC tells us how well a company is using its capital to generate returns. The higher these ratios, the better a company is at utilizing its resources to create value for investors. Debt can be a powerful tool for companies to fuel growth, but too much of it can be risky. Liquidity, on the other hand, refers to a company's ability to meet its short-term financial obligations. Metrics like the debt-to-equity ratio, current ratio, and quick ratio can help us assess a company's financial health. A high debt-to-equity ratio, for example, might indicate that a company is relying too heavily on borrowed money, which could be a red flag. Conversely, a healthy current ratio suggests that a company has enough liquid assets to cover its short-term debts. For income-focused investors, dividend-paying stocks can be a great source of passive income. Dividend metrics help us evaluate the reliability and attractiveness of these payouts. Metrics like dividend yield, dividend payout ratio, and dividend growth rate are key to understanding a company's dividend policy. A high dividend yield might seem attractive, but it's essential to consider the company's payout ratio to ensure it can sustain those dividends. And of course, consistent dividend growth is a good sign that the company is committed to rewarding its shareholders. Imagine a business that's like a castle, protected by a wide moat filled with hungry alligators. That's what a competitive advantage is all about. Companies with a sustainable competitive advantage are better positioned to fend off competition and achieve long-term success. Factors like brand strength, patents, economies of scale, and network effects can all contribute to a company's economic moat. Think of Apple's brand loyalty, Amazon's massive distribution network, or Google's dominance in search. These are all examples of companies with strong competitive advantages. Even the best companies can be affected by broader economic trends and industry-specific factors. It's like sailing a ship. You need to be aware of the wind, the currents, and any potential storms on the horizon. Macroeconomic factors include things like GDP growth, interest rates, inflation, and unemployment. Industry-specific factors might include things like technological advancements, regulatory changes, and shifts in consumer demand. By staying informed about these trends, investors can make more informed decisions about which companies are best positioned to weather the storm and thrive in the long run. Ever heard the phrase, insiders might sell for any reason, but they only buy for one? Well, there's some truth to that. Insider buying, especially when it's significant and sustained, can be a bullish signal. Institutional investors, like mutual funds and hedge funds, control vast sums of money. Their trading activity can move markets. While it's not always wise to blindly follow institutional investors, tracking their holdings and trades can provide valuable insights into market sentiment. The stock market can be a fickle beast, driven by fear and greed in the short term. Market sentiment refers to the overall attitude of investors towards a particular stock sector or the market as a whole. News headlines, analyst ratings, social media chatter, these can all influence investor perception and impact stock prices, sometimes irrationally. While it's essential to be aware of market sentiment, remember that long-term investment decisions should be grounded in fundamentals, not fleeting emotions. Congratulations! You've just completed a crash course in stock analysis fundamentals. Remember, investing is a marathon, not a sprint. Take your time, do your research, and don't be afraid to ask questions. If you found this video helpful, be sure to give it a thumbs up and subscribe to my channel for more insightful content like this. And don't forget to hit that notification bell so you don't miss out on future videos. Now, I want to hear from you. Are there any specific parameters you'd like me to cover in more detail? Drop your questions and requests in the comment section below, and I'll do my best to address them in future videos.